and analysis, driving better decisions. We're just going to wait another minute or two before we start and just allow people, a few more people to log in, and then we will kick off. In the meantime, a question that I have for the people in the audience, for those of you who have joined us for our previous sessions, and my belief is that we're going to be able to add these sessions to, something equivalent to a YouTube channel or something like that, or link them into the website, et cetera, as well. But the questions that we'd like to ask you is something simple as just popped up on our screen here. So what did you find most beneficial for today's webinar? If you can just make a note of that as you're doing that, and just feel free to text us the answer, then we'll have that. This is going to help us improve our future webinars as well. And the next question that I'd like to understand is just how many people are still using a cash basis accounting versus a modified accrual or accrual. So again, if you can just, message us with that information, that would be really helpful, just so we understand. And again, I can tailor the presentations a little bit more towards that. So it's 3:02. We'll just give it one more minute and then we're going to start. Okay, thank you all again. All right, we're going to start our session here. So let's carry on. Let's a little bit about myself. So yeah, I'm not a young person anymore. I'm 25 years experience. I'm a professional accountant by trade. Spent a lot of time working as a CFO, a COO, and then CEO of companies for quite a few years as well. Okay. Effectively, I'm part of the Ceteris team, helping small businesses scale and grow their profitability. And we provide some consulting services as well. So you can feel free to reach out to William. His contact information is also in some of your emails and so forth. And we're glad to chat to you about that. And that's about it. A very important part of, what we're doing is always starting with the end in mind. And the end in mind is business transitions, businesses grow, you keep building. So that's what we're here to help facilitate as well too. But effectively, our mission at Ceteris is really simple. We want to help the small business owners, meet their business objectives. Okay, we're here to provide you with timely, accurate monthly financial statements. What I'm hoping you're going to learn from today's seminars is how to use those monthly financial statements so you can better run your business. All right, so let's talk about the learning points for today. And the learning points are kind of exciting because we spent several sessions trying to teach you all about different things in the income statements, different accounting principles, cash basis versus accrual basis. But this is kind of where it all culminates together. So what we want to do is we want to walk you through more detail in terms of analyzing each component of your profit and loss statement. Okay, well, let's highlight the impact of those different accounting methods on the analysis as well. But we're just going to talk about it at a high level. We're going to focus more on an accrual or a modified accrual method in this presentation. We're going to talk about analyzing your net income on your monthly profit and loss statement as well. So your bottom line, okay, we want to know what your bottom line results are, and you want to know what your bottom line results are and how to increase them. I think that's a big reason for you being here today. Then we're going to talk about how your net income is analyzed by different users of your financial statements, okay? Some of your users are looking at it for very good reasons, and others are also looking at it for very reasons that may not excite you as much. And we'll talk a little bit about that. Net income. Last thing we want to do is as we transition all the work that we've done over the last few sessions on the income statement, we want to transition you and show you how the income statement ties with your balance sheet, or how your profit and loss ties with your balance sheet. So we're going to introduce you to that. So for our future session, when we talk about the balance sheet, you'll understand how they're flowing together. Great. Well, let's begin today. Okay. Before we begin, let's talk about why do businesses use financial statements. This is the guiding light for everything we're teaching. Okay. So the most important thing you should do with your monthly financial statements is evaluate the performance of the business every month. Okay, so to me, that's the first reason we do this. We don't do this because someone told us we should do it. We don't do it because someone is forcing us to send the monthly statements. But we do this as business owners or managers, so we better run the businesses. Okay, then from that information and that evaluation, then what we want to do is we want to make decisions and we want to make them fast. Okay, your financial statements are going to tell you where to look. Okay, they won't necessarily tell you what to do, but they're going to tell you where to look. And we'll talk about that as well today. And then the other reason why we do them is to maintain those partner relationships and fulfill compliance requirements. So that is a reason why we do our monthly financial statements, but that shouldn't be the first reason. Great. So moving along, let's talk about analyzing the results from your profit and loss. And your profit and loss is broken into various categories. So when we're analyzing something, we're going to break it down into categories and subcategories. All right, perfect. So really quick, again, let's talk about the income statement. Really important, high level for those joining us for first time here. So the whole purpose of the income statement is really to show you how much money your business made, which is your revenue up in here, how much your business spent, which is your expenses, and your expenses are segregated into two types of expenses, okay? We have your variable expenses or your costs of sales or cost of goods sold. And then we have your operating expenses or your fixed expenses down below here, which tends to remain more variable. At the end of the day, the equation is really simple, which is our profit less our expenses. The two red items equals our net income. All right. So on the modified accrual, so the reason why we really want to look at modified accruals and accrual-based accounting is because revenue is reported when a sale is made, not when the cash is received. Okay. The costs, okay, whether they're costs of sales or the fixed costs, those costs are also reported on your profit and loss for the period that they're incurred and used, not the period that they're paid. The period paid is on the cash basis. So one of the biggest challenges with using cash basis financial statements to analyze monthly performance is that if you have a month with high cash receipts, okay, you tend to pay more expenses, okay? And now what we're really getting is we're trying to analyze how we paid our expenses, not the profitability of the business or how we paid our bills, okay? So this is a main reason why the accrual and the modified accrual are super helpful in analyzing your financial performance. Okay, so we also have another aspect here. We have something called our gross profit, which is over here. Our gross profit is effectively our sales, which are variable, less our cost of sales, which are variable costs, and that gives us our gross profit. Gross profit is one of my 2 or 3 go-to numbers the first time I look at whenever I get a new set of monthly financials. That's what I want to know what changed. Okay, that's literally almost my first go-to place. I do look at revenue, but I look at my gross profit to see what's changed. I look at my expenses to see what's changed, and I look at my operating income. All right. And then I go further into investigation. But as we say, gross profit is a function of what was sold and the direct costs that relate to it. So it's very accurate and representative when you're using an accrual type method or a modified type accrual. Your fixed business expenses or your operating expenses, that's just, what was used to generate that money as well, too. But it behaves much differently. So your net profit is really your gross profit, okay, less your operating expenses gives you your net income. All right. So it's super important for us to define your revenue streams and to define those revenue streams in a logical way, okay? And we do that by subcategories. So, often if you're looking at some high-level external financial statements, you'll see total revenue and it's one line, okay? One line really, it tells me one thing, but it doesn't really tell me what's going on. So as you can see from below, we get much greater analysis if we have sub-accounts and we can understand what the cost structures are behind each of these sub-accounts. So can marketing or selling costs be directly traced to this type of sale? If so, that's a reason why I like to segregate it. Does it have a different variable cost behind it? If so, that's a reason why I like to segregate it. Is it important in monitoring that sub account of your revenue long term to understand the valuation and the direction of the business? If so, again, that's another reason to segregate it. Do I want to understand this revenue stream over time? And does it matter? Is it material? I'm not a big fan of small dollar amounts being tracked in the buckets. I would rather buckets real small amounts over there, unless that small amount has an opportunity to become a big amount. Okay, then I do want to track it. So let's talk about analyzing your revenue. And we've talked about this before, but I'm going to give you three different comparison periods, and I'm going to show you how those three different comparison periods add light to each one of the dimensions that you're looking. So this month over last month. Okay, so I choose this month over last month just to see what I call my short-term progress. Okay, and I like to compare, each of the categories against each other month over month. All right. The issue with this is that in seasonal businesses, okay, month over month can be dramatic. Okay. So, for example, December sales versus January sales can be dramatic in a lot of businesses. So, month over month may not help me as much. So, then I like to look at another type of statement, which is show me last month, a year ago versus this month a year ago. I find this really good because now it's really showing me the direction over 12 months. Where has this moved? Okay. So super important to see that. And as you can see in this case, okay, we didn't see anything much between June and July on the monthly statements in terms of the sales and shops. And for all I know, maybe June had more weekends in it than July did. July has 31 days, June has 30. So in theory, it should have been higher if all days are equal. But, sometimes a Friday and a Saturday is a more important day for a business than a Tuesday or a Wednesday. So all these things, however, okay, now I'm comparing 31 days versus 31 days, and I'm comparing them over a year, and I really understand what's going on. So here we got a 16% growth. Okay. So now all of a sudden, July's sales in the shop, when I looked at month over month, didn't look very good. Now, when I compare year over year monthly, then I see how much it is. My next one that I love to look at is this really helps me understand long-term trends, which is year to date versus year to date. Okay. So year to dates versus year to dates give me a nice explanation and go, okay, so although I did 16%, okay, I'm trending really at an 8% growth when I look at all of the factors into it. So again, what we're trying to do is analyze the opportunities and threats, and we're trying to do that from a couple of different angles. Okay, that's really what we're doing here. So comparing these periods just gives you a better understanding of the successes, your opportunities, your threats. So let's define your business expense, and it's going to be the same methodology. Okay, we group similar costs under categories so we can understand the performance of them and understand if we have to make corrective actions. But the categories of business expenses are your cost of sales, which are your variable costs, which help us understand gross profit. And if some of you remember from our session 4, we've also used our gross profit, our gross margin, to help us understand our break-even point. Fixed costs, okay, our operating expenses tend to be fixed in nature, and that helps us figure out what our operating profits are. Then the third category of expenses is other expenses, which is discretionary or unusual costs. I find it super helpful to separate those, and you'll stay tuned and you'll find out why. Okay. And effectively, what that does is help us understand the difference between net profit, okay, which is going to be used for tax purposes, for several other purposes, versus our operating profits, which is really telling us how well we're operating the business. Okay, perfect. Let's talk about your cost of sales. Okay, the variable costs that increase on incremental sales is what we said what is. Okay. And generally, all of these charts of accounts are set up, either, if you're a franchise, they might have a template where it's set up. If not, you're working with your team, et cetera, or whoever your accountant is to help make your chart of accounts. And hopefully they understand how to do that in a logical way to drive things. But key considerations on defining these are, does the sub-account have a different variable cost structure behind it? Okay. How material is the amount every month? Will it help me make better decisions? Okay. Is tracking an important aspect in the long-term growth and sustainability? And do I want to compare this in against time? Okay. And over a specific revenue stream. So those are, those are the items in revenue and the items in cost of sales. Now, when we segregated those out correctly, it helps us understand our gross profit, again, which is one of my go-to spots, okay? We measure gross profit to understand your efficiency, your pricing effectiveness, and to manage our direct costs, okay? So when we measure gross profit, we measure and understand how changes in sales impact our gross profitability, and we'll go through some examples of that. How changes in direct costs, okay? So gross profit can move because of the sales, gross profit can move because of the cost of sales, gross profit can move because of the combination of the two. All right, perfect. And we talked that gross profit, when we divide the gross profit by your sales, we have your gross margin, and gross margin is helpful for break-even analysis, and gross margin, which is 8%, okay, is also very important in telling us the successes and challenges the business is facing. Okay. All right. My preference, monthly. So analyze this amount monthly. Great. So let's talk about analyzing this amount. Okay. So we do this by streams. We do this when possible. Okay. So in this fast food example, it's not by streams. Okay. It's by major categories. Streams would be if I knew what all my costs were for kind of, let's just call it in-store sales versus delivery sales versus party sales. And I knew the cost breakdown for those because my margins on my delivery sales are going to be very different than my in-store sales and my party sales as well, too. However, sometimes it's more important to break it down by the nature versus by understanding those different margins. However, when we break it down in this matter, we do understand what our prime drivers are against it, and we understand how those ratios have changed over time. Well, in this case, we're analyzing month over month. So what we're finding is that these numbers are being quite consistent, not entirely consistent, but quite consistent, okay? However, we did have a 3% slippage, okay, or 2.5% slippage, 3% rounded up. Provide focus on corrective actions or your pricing. So what's happening if your variable costs are increasing, okay, and your sales aren't increasing in price? Well, you're going to take it in your gross margin. So ideally, you want your pricing to move with your costing, or you've got to reduce your costs, and maybe you do that through different supplier networks. Maybe it's portion control. Maybe there's other kinds of things like that you can reduce your costs in this type of business. So we analyze it by moving the month over month. Again, do the comparison year to date versus prior year to date, and last month over the same thing last year, last month. Each of those angles for analyzing it are going to help you understand what's going on, identify the changes line by line, and identify corrective actions. Now, remember, a lot of this analysis, okay, think of your financial statements as a little bit of a thermometer, okay? It's telling you what's going on. It's not necessarily telling you why it's going on, okay? The why you have to figure out, okay, yourself. And if you don't have that ability or you find it, you want another perspective, that's another reason for getting somebody who's, been around and has some different suggestions on what to tackle in managing those costs or exploiting the opportunities on your top line. All right, perfect. Let's talk about defining the fixed costs, okay? So there's lots of categories for fixed costs, but the concept is the same, okay? The concept being they got to be, material enough. They have to matter. You want to monitor them over time and so forth. But rent and occupancy is generally very material for most businesses. Advertising fees, okay, this is one in marketing. This is one that you want to monitor because you want to understand the impact on the top line, okay? So even if it wasn't super material, I'd want it separately lined item so I understand what's going on. Sometimes within the advertising fees as well, too, I'll segregate it. So for example, I know what we're spending, for kind of delivery advertising, what we're spending for in-store advertising, what we're spending for party or catering advertising. So you can sub-account the sub-accounts as well and just roll them up. Bank fees and interest, that you want to segregate because it's an add back in determining your EBITDA or your earnings before income and taxes and depreciation. So that's another reason why we like to segregate that. Employee related benefits and costs, definitely want to monitor that as well too. Your management fees, okay, assuming that your management fees are reasonable and fair, I like keeping that in my fixed costs. If there's a portion of management fees that really has to do with me owning the business, not what I'd be paying someone to run the business, then I'm going to put that in my other expenses, okay? The professional fees as well, insurance, okay, and other general costs. So perfect. So here we've identified, kind of, a few buckets just simply here just to show you what's going on with those things. Okay. So again, your fixed operating costs, they tend to be flexible and variable. Okay. Not so variable. Okay. Less variable. But they'll move in steps. Okay. Your insurance won't, but your rent typically moves in steps. Okay. Other fixed costs move in steps. Okay. So, again, we've talked about keeping this, does this remain relatively constant? They should remain relatively constant month over month. Year over year, they can change, but month over month, they generally remain, okay? And will it help me make better decisions? And is it important for me to track? Okay, do I want to compare this against a specific revenue stream over time? So defining the other expenses, okay. Costs that are not tied to the core operation of the business. In other words, are not charged to the variable cost side of the equation and include non-operational discretionary. So this is the other expenses. This is I've also called it owner's expenses. This might be your car payment. Okay. This might be things of that nature that are kind of discretionary. And if it wasn't you owning the business, wouldn't be inside there. They can also be other things as well. So management bonuses, discretionary expenses, meals and entertainment, ownership bonuses, vehicle costs, home office expense, loss on sale of assets. Now we're getting to things that are just irregular, okay? Legal fees that are not typical, restructuring costs, gains and loss from investments, corporate taxes will fall inside there as well too, but they're not part of the routine ongoing operations of the business. All right, now we're getting to the fun stuff. Let's analyze your profits, okay? Remember that further investigation, okay? Then you put your corrective actions in place. So then you're looking at your new financial statements, your new monthly ones, to seeing am I improving on it or not. And again, what we're really trying to do is just maximize your profit. All right, so let's talk about measuring the net profit. So this provides an understanding for the total profit of the entity. When we're measuring the net profit, okay, we understand the total profitability, okay, the cumulative effects of revenue, direct costs, and operating costs, okay. Valuation is also based on total profitability. Now, personally, when I'm selling or getting involved in small businesses selling, you like to have that at kind of the net operating profit, not the net income, okay? And it's always easier if those costs are segregated, the discretionary costs, if they're segregated, because it's just harder for anyone to sell a business when you got to pull out this amount from this line, this amount from this line, this amount for this line, and then you got to justify it to the buyer. So always good to do that. So net profit, okay, shows as business total profitability over the time of the business. So, is your business going ahead? Is it not? That's kind of obvious. We're doing that. So measuring operating profit, as we talked about, now we're talking about your operational efficiency, your managerial efficiency, your pricing effectiveness, and how well you're managing your variable costs. When we measure operating profit, we measure and understand the core profitability, how efficient your business is, management operational efficiency. The valuation is based on normal operations, which is, what people would prefer. Okay, so operating profit shows the business trajectory over time. It's the sustainability, cost management, and how you can compare it against its peers. If you've got a whole bunch of other things inside some of your fixed costs, okay, that really shouldn't be there. Now, when you're trying to compare it against your peers, the water becomes what I call murky, and it's harder to do. Let's talk about analyzing that operating profit. Okay, so we review the fixed expenses and provides insight to determine what expenses we should investigate, provides focus on corrective actions, and we analyze operating profit as a whole by movements over month, again, year to date over year to date, and last month, last year versus the last month. Let's identify those changes line by line and identify corrective actions. So let's take a look at an example here. We're analyzing the operating profits by reviewing revenue line by line. Okay, so in reviewing revenue line by line, we've got green colored lines and red colored lines. Okay, well, the green colored lines are they're doing super good. Okay, so there was sizable increases, 8% and 8% in this case. Okay, the sales to kind of parties and things of that nature, the catering side of the business, let's just call that. Okay, it took a dive. Okay, and then the discounts went up really hard. Well, that's not a good thing to have our discounts go up high. All right, but okay, overall revenue increased by 5%. But see, if we're just focused on overall revenue, you're going to say, well, things aren't so bad, maybe. Okay. Well, my question to you is, okay, if you've got an 8% change year over year and your pricing increase was 5%, how much did you really do? Well, you did 5 minus 8 is 3%, 3%. Here, you actually lost 17%. Okay. And so on. So you see, you've got to, this provides part of the equation, but you've got to apply logic to what you're doing as well, too. All right. So we do that and we see the healthy decrease, okay, the paterings, okay, and so forth. So we had successes, we had victories. On the discounts, we had a huge loss. On the sales department, we had a huge loss. In the delivery, we had a nice gain, okay, and a nice gain on in-store sales, okay? So why the price increase? So why the increase? Did we raise prices? Were there more customers? Or was it just the price increase that drove the change, okay? Why the decrease? Okay, you can ask the same question. So in the catering, did we lose a major account? Did we lose someone who's ordering once a month, $500-600? If we did, okay, well, over, that could be that over the year. Okay, so analyzing operating profits by reviewing the costs of sales. So again, now we want to see what's going on. Now, when we have 71,000 moving to 82,000, we're not concerned in our food costs, okay? Because that's still, in this case, we are concerned because that's a 2% increase. But for example, the paper is remaining constant at 2% of sales, even though it grew. This $800, it remained variable with the price. So we do want to really look at the percent of sales versus the percent of sales versus the absolute numbers, because the absolute number should be moving up with sales. So just make a mental note of that, that's what you want to be doing. Obviously, okay, if we had a 5% increase in total revenue and a 1% decrease in our bread costs, we actually came very ahead, okay? Because we came the 5% that we moved on the revenue plus the 1% we saved, so we actually came 6%, okay? On the food costs, we can take the 5% off the 15 and say, okay, well, we expected to have a 5% increase, okay, due to this, but you see, we actually grew significantly more. We grew at 15%. So we've got an issue with our food, our sides, paper. So, what are corrective actions? Do we need a price increase? Do we need a new supplier, or are our staff just simply putting up too much product, okay, on there that we're not getting back? So there's possible outcomes for why this is happening. And then the investigation starts to analyze which one of these outcomes, has happened. And, you can compare vendor invoices year over year to see what happened to the change. Okay. You can do things of that nature to see, okay, so was it something from the vendors that I wasn't able to recoup at the top line? Or is there an inefficiency in the management of my staff? And are they, is there theft? Are they putting too much food on there? Are they giving free food to their friends? Okay, all of these types of things could be happening. Don't know what it is, but I know it's time to look. Okay. And then you're going to put some actions in and you're going to look again to see what's going on. But that's effectively, so analyzing operating profits by review. All right, so when looking at this, we see that, okay, our sales went up, kind of 5%, okay? But our gross profit didn't go up, Okay, it should have gone up at least 5%, if not more, but it didn't. Okay, it went down because we also got hammered on our cost of labor. Okay, does that mean we're spending too much money on labor? I don't know. Okay, you could have very inefficient people working as well too, so you need a lot more of them. Don't know. You could have very inefficient people that are throwing out a lot of food because they're not doing the cycling of the food correct in the freezers. Don't know, but know it needs to get looked at. Okay. Analyze operating profit by reviewing the fixed costs. Okay. So here, for example, okay, we're seeing that our advertising, is gone down, which is a good thing because that helped us, recoup some of the loss we had at our gross profit. So, here we're trying to win the game now here, and we did a little bit better because our total expenses dropped 3%. So as a result, we actually, ended up being further ahead last year. But you see, there's lots of problems, even though we're further ahead as a percentage. Okay. And we can't just go, okay, well, we're further ahead, so all's fine. No, there's an opportunity to make a lot more money. The devil's in the detail, and it's time to look into it. But that's the kind of stuff that's going on. The advertising, another thing. Well, maybe did this advertising decrease? Was that the reason why our catering and our party sales was lower? Okay. Well, you investigate and look into it, then you figure it out. Okay. So not always, okay, are you looking for an expense to be lower? Sometimes you're looking for an expense to explain what the heck is going on or a lost opportunity. Okay. Net operating income increases, but still lots to optimize here. Good stuff. All right. Net income analysis and the users of your financial statements. Okay. So in this case, we've spoken earlier that there are many different users of the financial statement. Okay. There's management, investors, creditors, authorities, and shareholder members. Okay. Regulatory authorities would include the government for taxes and so forth. All right. So given now that I've told you that there's regular authorities that are looking to see your profits as well too, you know, this is where we're talking about the net operating income and your net income being somewhat different, okay, from each other. Um, okay, perfect. All right. So, so moving to this, the basic users of the financial statements, okay, and the basic financial statements. Let's start again as your balance sheet. Balance sheet shows you what you own, what the difference is, which is your equity. All right, the income statement showing you how much you made and how much you spent, and then the statement of cash flow expanding. So those are your three basic statements. Okay, users of financial statements that prefer to you prefer to show less profit to. Well, I haven't seen too many business owners that want to show the government that they made more money. And at the same point in time, you want to show your investors or your creditors, the bank, or other people that you're making more money. Okay, sometimes your landlord will brace things as well too and say, okay, well, I see that you're getting very profitable, so now how am I going to sneak in some variable rent charges on you or some extra camera, things of that nature. So you always want to show them less. Okay, so how do we show more to one group of people and show less to another group of people? And the answer is by segregate. Okay, now we don't want to segregate it to draw red flags, okay? But we do want to segregate it so that the explanation is succinct and understood, okay? But, you know, it is important for people to understand what your core profitability is from your operations. And that's highlighted in green, showing what your total net operating income is. Okay. So that's very important to show. However, in the other expenses is where we might have some of those discretionary or unusual items that impact it. Okay. And in this case, okay, we're seeing that although our operating income increased and it's positive, okay, our net income near doubled, okay, but this is the case. Now, if all these expenses are buried inside your general kind of expenses, your general operating expenses, it gives them kind of a wrong impression of the the profitability or the true profitability of your business. So that's why, again, I like to segregate them, like to analyze them, like to show what's going on. Okay. So again, the solutions, we've talked about it, okay, is in segregating, okay, and then you're seeing stronger profits, so for a lot of other people, you're talking about this number, and for these people, you're talking about this number, okay? So now you've got two different profits to show people, and you've got an easy explanation for why they're different, which is the sub-accounts. All right. Perfect. So last thing that we're going to tackle today before we get to questions, and looking forward to good questions. But the last thing we're going to tackle today is the flow of net income to your balance sheet. Okay, so we've spent 5 sessions talking about your profit and loss statement. And then your profit and loss, we're talking about showing, how much you made, okay, and what you spent and what was left over, your profit. Now, how does that relate to your balance sheet, what you own, what you owe, and what the difference is your equity? The answer is in this next 2 slides. All right, so remember the balance sheet, we have our assets, okay, which is what you own. And again, there's current, other current, and long-term, just to let you know when we classify assets, okay, we classify the things closest to cash at the top and furthest from cash at the bottom, okay? On your liabilities, we do the same thing. So things you got to pay right away are up higher. The things that are, longer and less, less taxing on you get to go at the end of your liability section. And your liabilities, again, is what you owe. And the difference here is your owner's equity. Well, the owner's equity has various components, okay? It has your retained earnings. This will usually be at the start of the year. They have maybe what some draws have been, from your equity as well, too. In other words, how much extra distributions did you take? And then net income year to date as well is rolled up in here. So your net income from your income statement falls into your balance sheet. And if you think about that from a personal level, okay, let's just say that you made $5,000 this month and you spent $4,000 on various expenses. You were left with $1,000. Well, where is that $1,000? Maybe it's in the bank. Okay, maybe you bought an asset with it. Maybe you bought a painting with it. Maybe you did something with it, but it's not an expense because your expenses were your $4,000. So whatever's left over has to make it to what you owe, and the difference. And in this case, it's making it through to the difference, and it goes through there. So your assets equal your liability plus your equity. And we can also rewrite that differently, which is your equity. This section here is the difference between your assets less your liabilities, okay? Which, again, you kind of know that from common sense, because if you want to know what you're worth, you kind of add up all the things you owe and you subtract all the things you own versus all the things you owe, and the difference is your net worth. And that's kind of the way it works for the businesses too. All right, so the most important thing to understand is that profit flows. Okay, here we have our income statement up here, and here we have what the net earnings are, and the net earnings goes into your retained earnings. Your retained earnings can be shown several different ways, but it could be your start balance plus your net income equals your ending balance, or it could just be lumped into the retained earnings as a total number. But your profit from the income statement becomes a component of your retained earnings, a category within the equity of your balance sheet, okay? This also shows you that your equity or your net worth has grown, as we talked about in the example. And net income and profit is now reflected on your balance sheet as a one-line item on what happened to your profit and loss. So you can also think of that as a one-line consolidation of what you made, because at the end of the day, regardless of your revenue, okay, it's all about your profit, and your profit is what sinks over here. Good. This also, remember, the retained earnings is going to show your progress over time. So if banks and various other creditors and other people, when they look at your retained earnings, what they can say is, okay, this business has been around for 10 years, and this is how much it's made in 10 years. So I have a rough idea of what the earnings are per year. They also look at it for those kinds of analysis. So that is our session for today. Looking forward to any questions that you might all have and some feedback as well too. So please share with us your thoughts on that. Okay, so I got a question here. Okay, how should I handle a situation where I find my expenses lower than expected? Okay, so expenses lower than you expect. Now, automatically, most people think, well, that's just a good thing. And the reality is it can be, or it might not be. Okay, because remember that the reason why you incur an expense is to make money. So if your expense decreased and you're not making as much money, maybe that expense was really important to maintain. What it does tell you is any change that's relatively significant. Okay, anything that's changing your profit by, depending on the size of business they are, about 1, 2 to 3% is changing your profit, needs to be investigated. And again, there's circumstances where, for example, if you spend no money on marketing, that can have a very negative impact on your sales. So that would be an example to look. All right, perfect. All right. Next question. How can I use these statements proactively to determine figuring out things like adding more staff? Okay, so when do you add more staff? So one of the things I like to do when I'm working with businesses is I like to forecast and model. So we take the monthly financial statements, we push them into Excel, and then we do things. Now, whenever you add expenses, okay, the objective is to see some other reaction, preferably on the top line, okay, to those expenses. So, for example, if we're adding a person, let's just say we're so busy, we've got our little fast food franchise store and it's doing really well, but it's doing so well that there's a big lineup. Okay. And the owner is going to go, well, look, I can see people walking away, so maybe it's time for me to add another staff member. Okay, now they're making those judgments because they're there, they're seeing the stuff and so on. Some of the owners are there and physically see it. Some of the owners aren't there. Okay, and they can't see it. But what you'll do is you'll model the expense out. So let's just say we've hired another staff member and he's costing us $3,000. Okay, he's costing us $3,000 extra a month. Okay, so what's going to be my impact to my top line? Well, I think I'm going to get 10 more sales or 20 more sales during lunchtime. And that average ticket price for the sale is $20. So I should get $600 extra a day. Okay, so you model the top line effect. Okay, then when you've modeled the top line and you've modeled the bottom line, you know what's going on and you have more of a comfort level, okay, in doing the hiring. So that's an example of how you do it that way. Yeah, so are there any other questions from our team here? Let me just see if I can talk to the rest of my team. Um, they're able to pass me anything else.
Hi, yes. We have one more question here from the audience on how can I use these statements proactively to determine figuring out like adding more stuff, or is that one the one we just reviewed?
Yeah, exactly. I
Awesome.
was able to get that one. Any more questions or did we get any results from our surveys, Anna?
Yeah, so most of the audience is actively using the cash-based accounting only.
Okay. Yeah. So again, with the cash basis accounting, what I would do is I would focus on using the year-to-date numbers more than month over month. Okay. The longer period of time that you look at under the cash basis, the more relevant the differences, they'll kind of shrink between cash and accrual. It's not that they're not there, they're still there, but they're just not there in the magnitude. So, in other words, under the cash basis, it's a little harder to make those instantaneous reactions, but you still can make reactions by understanding trends over a period of times. You might want to compare quarter versus quarter as opposed to month versus month. You may want to compare year to date versus year to date, and you'll get benefit out of everything we've talked about. It's just that you're going to have more clean information. The whole reason why accountants created all these rules was not to complicate life, but to try to get to the reality of how much profit did you really make versus, how fast people paid you and how fast you paid expenses. So how many participants are using the cash basis account only for preparing? Okay, so yeah, we got quite a few. We got 3 out of 3. Um, good. Okay, good. Well, that's it. Again, we liked your feedback, so you feel free to join us. And Anna and William will be reaching out to you for our next session, which is also going to focus on more management around the balance sheet. The balance sheet's going to help you understand how to manage your cash a little bit better. So there's managing for profitability, which is something we discussed heavily today, and there's also managing for cash because you don't want to run out of cash. All right, perfect. And on that note, we thank everyone for joining. If you enjoyed this, please share this seminar with other people, and we look forward to having you join us again. Thank you very much.